This is Boring Money by Sridhar, read by Joel D'Souza. The title of this post is CarTrade Takes Its Own Sweet Time to Buy GoMechanic, and the subtitle is Or How a Failed Startup Might Make Its Founders Very Rich. Let's begin. The idea goes that startups are valued not based on their potential for profit, but their potential to sell stories. If you're a startup that isn't profitable, you really have no money of your own. So your stories better be good to impress your investors to continue to give you money. What makes for bad storytelling is lying about your business numbers and financials to your investors. I've written before that investors don't care too much about fraud against the public, government, etc. But they definitely care about fraud against themselves. Accounting fraud is fraud against your investors, so they really care about it a lot. 2 months ago, GoMechanic's founders admitted to some accounting fraud, and investors weren't super happy. GoMechanic is in the business of aggregating car service garages on their platform, like Oyo does for hotels, and their accounting fraud was to say they had more garages on their platform than they actually did, and hence more revenue. In early 2022, the founders had great storytelling abilities and were looking to value the company at $1.2 billion. After this fraud stuff became public, their storytelling took a hit, and now they're looking to sell off the company at $30 million. I want to emphasize that between early 2022 and early 2023, nothing particularly changed in how the company did business. Yes, the founders had exaggerated some numbers, and the overall startup funding market is down, but the GoMechanic business in 2022 wasn't very different from the GoMechanic business in 2023. If GoMechanic has exaggerated its revenue by, say, 20%, the rational way to look at it would be to discount the valuation by around the same figure. But that's definitely not how startup valuations work. If you're a startup founder that lies to investors, it makes for a bad story. And that makes your company worth much less than it would be otherwise. Next section, CarTrade gets a better deal the longer it waits. The Morning Context reported earlier this month that CarTrade, a second-hand car marketplace, was going to buy GoMechanic for $30 million. CarTrade denies that any decision has been made and instead says that talks and considerations are ongoing. If there is a fire sale, as a buyer, you'd want to buy up the goods ASAP before someone else can scoop them up. But CarTrade doesn't seem like it's in too much of a hurry. One significant difference between regular fire sales and startup fire sales is that few buyers can actually buy the entire startups. If you're a startup trying to desperately sell yourself, it's actually either your competitor or a company in an adjacent space that can get any value out of you. Now, there aren't too many startups in the same industry as GoMechanic. Working with garages is difficult. They are fragmented, extremely tech-averse. Even teaching garage mechanics to use your app might be quite a challenge. And if you've ever tried to service a car, you'd know that honesty isn't garage owners' strongest suit. GoMechanic clearly fit right in. GoMechanic didn't have too many competitors to begin with, and it's easy to imagine that those that existed wouldn't really have cash to spare to buy a whole company. So GoMechanic's best bet would be companies in an adjacent industry. It reached out to everyone, including Cars24 and Spinny, two of CarTrade's direct competitors in the used car industry, but they refused. If you're CarTrade and you want to buy a company that was valuing itself at $1.2 billion the year prior, which had been valued at $285 million 2 years prior, for a steal deal of $30 million, you'd normally just leap in to buy it. But if you're the only buyer on the market, the longer you wait, the more desperate the seller gets, and the better deal you get. What makes it even more difficult for GoMechanic to sell at the $30 million price is that Orias Venture Partners, one of the company's early investors, told its own investors that their investment in the company was worth nothing. That's probably a price that CarTrade is willing to pay for GoMechanic. Next section, Orias expects to get nothing. The founders get rich? If we went forward in time and saw that GoMechanic did manage to sell itself for $30 million, or $10 million, or $1 million, or whatever, would we think of the startup to have been successful? The answer is no. No, absolutely not. GoMechanic has raised $62 million till now, so selling for anything below that just means that it burned money. But can a failed startup be profitable for its founders? GoMechanic's 4 co-founders own about 25.5% of the company. If GoMechanic does sell for $30 million, they'd get about $6 million, or around 50 crore rupees, between the 4 of them. And that doesn't sound too bad, honestly. If you were an early investor in GoMechanic, like Orias, you burned money. But if you're a founder, being able to sell at any price means that you get rich. Thank you for listening to Boring Money. Make sure to subscribe to boringmoney.substack.com to receive future posts directly in your inbox.